On December 2010, Groupon shook the business world by turning down Google's $6 billion offer. Founded just 2 years prior in 2008 by Andrew Mason, Groupon was a rising star in the daily deals market, transforming how consumers and businesses interacted. The decision to reject Google's acquisition wasn't just bold, it was one of the most shocking moves in startup history. The scene was set in Chicago, where a small startup, Groupon, began its journey in November 2008. Andrew Mason, a Northwestern University music major with no business background, envisioned a world where local businesses could reach new customers through innovative online deals. The idea was simple, yet groundbreaking. Provide a platform where consumers could access exclusive deals while businesses gained new customers without the need for traditional advertising. This model garnered attention quickly, drawing investments from new enterprise associates and Excel partners, and skyrocketing its valuation. By the end of 2010, Groupon had become a household name, boasting over 35 million registered users and operating in more than 500 markets worldwide. The company's revenue was estimated at $713 million, a staggering growth from just $30 million in 2009. It was this explosive success that caught the eye of tech giant Google, which saw potential in integrating Groupon's local deal focus with its own vast reach and resources. Rejecting Google's offer was a gamble rooted in confidence. Andrew Mason, along with co-founders Eric Lefkofsky and Brad Keywell, believed in Groupon's potential and its capacity to grow independently. The decision was supported by the company's rapid growth trajectory and the belief that a public offering could bring in even greater success. With advisors and board members like Peter Barris and Kevin Afrusi, who had witnessed the rise of other internet giants, confidence was high. However, this moment marked the beginning of a turbulent journey. In November 2011, Groupon went public, pricing its IPO at $20 per share and raising $700 million, making it the largest IPO by a U.S. internet company since Google's in 2004. The initial success bolstered Mason's decision, as the company was valued at nearly $13 billion. Yet, beneath the surface, cracks were beginning to show. The market was evolving, competition was fierce, and Groupon's business model faced scrutiny. Between 2012 and 2015, Groupon's fortunes waned. Revenue declined as the novelty of daily deals wore off, and consumers grew tired of limited-time offers that often came with strings attached. Accounting scandals emerged, with the company restating financial results due to material weaknesses in its internal controls. Consumer trust eroded as users found deals less compelling, and merchants complained about low returns on their promotions. The stock price plummeted to as low as $2.50 by 2015, a fall of over 89% from its IPO price. Investors who had once seen potential now faced significant financial losses. Andrew Mason, once a celebrated entrepreneur hailed as the next tech visionary, now found himself under fire. The decision that once seemed visionary was being questioned. In hindsight, Mason admitted that rejecting Google's offer was a mistake, a humbling acknowledgement of misjudgment. He was ousted as CEO in February 2013, a move that reflected the board's lack of confidence in his leadership amidst the company's declining fortunes. The repercussions of Groupon's decline were far-reaching. Employees faced layoffs, with the workforce shrinking from over 12,000 at its peak to fewer than 7,000 by 2015. Morale dipped as the company underwent multiple restructurings in an attempt to find a sustainable path forward. The loss of talent was palpable, as many original team members left to pursue new opportunities, taking with them the innovative spirit that once defined Groupon. Small businesses that relied on Groupon for customer acquisition also suffered, as the platform's waning popularity led to lost revenue and diminished visibility. Many local businesses found themselves unable to replicate the initial success of their Groupon campaigns, grappling with the challenge of converting deal seekers into loyal customers. The root of Groupon's challenges lay in its overconfidence and inability to adapt to a rapidly changing market. The rejection of Google's offer was based on an overestimation of its growth trajectory and an underestimation of emerging competitors like Living Social and Amazon Local. Additionally, Groupon's model attracted deal seekers who were not loyal, leading to unsustainable practices and diminishing returns for merchants. Groupon's story serves as a cautionary tale, a reminder of the delicate balance between ambition and realism. The narrative underscores the importance of strategic decision-making and understanding market dynamics. For Andrew Mason and those who followed Groupon's journey, the lesson is clear. Success in the startup world is as much about foresight as it is about innovation. In the aftermath, Groupon has sought to reinvent itself, shifting focus from daily deals to becoming an online marketplace for local services and experiences. While the company has managed to stabilize to some extent, the shadow of its past decisions looms large. The story of Groupon is a testament to the unforgiving nature of the tech world, where timing, strategy, and adaptability can make or break a company. As Groupon continues to navigate its path forward, its history remains a powerful lesson for entrepreneurs and investors alike. The road to success is fraught with challenges, and sometimes the toughest decisions are the ones that shape the future.